Hi, welcome. I'm Josh. I'm a reporter with Politico. I cover antitrust, policy enforcement, litigation. I've been on the beat for close to 10 years, so I've been following this for quite a while. We're here to talk about mergers, so it's a fairly timely subject. There's a couple things going on lately with mergers, specifically tech, but sort of across the economy. And we have a great lineup. So we'll start by introducing folks. On the Zoom is Diana Moss, who since 2015 has been president of the American Antitrust Institute, a sort of nonprofit that advocates for aggressive antitrust enforcement. To my left, we have John Talladay, a partner with Baker Botts, who practices a wide array of antitrust matters. Doug Melamed, a professor at Stanford, former Intel general counsel, and former acting assistant attorney general at the DOJ Antitrust Division, and Melanie Aiken, who's the managing principal of Bennett Jones U.S. practice, and prior to that was Canada's competition commissioner. So just in the last couple of weeks, there's been sort of a lot of new developments in mergers after we sort of got together to sort of hash out what we wanted to talk about. And just last week, DOJ lost two. We're here to talk about tech deals, but I don't think we can have that conversation without talking about what's been going on in the last couple of weeks. And DOJ lost two merger challenges. One in the sugar industry and one in a vertical deal in the healthcare sector. And so I think that's going to tee up a lot of sort of soul-searching decision-making about how to move forward with their merger program. And just this week, they started another trial in Boston challenging a partnership, not a merger, but a partnership between JetBlue and an American Airlines. And that's not pled as a Section 7 case, but in court, they're describing it as a de facto merger. So with that as sort of a background, both heads of the U.S. enforcement agencies articulated sort of a vision of a much more aggressive stance, greater skepticism, sort of at large, even maybe a hostility towards deals. What's driving this increased aggressiveness, and sort of what does it mean for M&A in the near term? What's the sort of foundation for this kind of new stance? And we'll start with John.
Thank you, Josh. And thank you to LeadershIP for the invitation. This administration came in wanting to be more aggressive on mergers, not just in the digital sector, but across the board. Some of that stems from research that had been done, suggesting that in certain segments of industry, there had been a lot more consolidation, and companion research that suggested that the returns to companies had been increasing at a faster rate than the returns to the employees of those companies. There's a lot of controversy around the research itself, and you can look at some of the articles by Josh Wright on that. I don't think it's really material, but it did inform, I think, the incentives of this administration to be much more aggressive. And if you look at some of the things that they've done, you can see that there's been an effort, I think, to put a chill on merger conduct generally. Not just based on what they say, some dogma that comes out as they speak, where they're very aggressive in asserting that mergers should slow down. But there have been specific actions to chill mergers, and I'll just tick off a list of them, and some of you know these as well. But first, they suspended granting early termination for deals. And keep in mind, this applies to deals that almost by definition are not problematic, because those are the deals that get early termination, so they stopped that. The FTC issued omnibus regulations to facilitate ease of investigation. So essentially, one commissioner can now authorize an investigation. They rescinded the 1995 policy statement regarding prior approvals, and now they are routinely requiring prior approvals in deals where there is any sort of remedy. sometimes giving themselves 10 years of unfettered discretion, not subject to the restraints of the laws as to whether deals should be approved or not. They have issued warning letters. So even deals that at the end of the initial 30-day period, they've decided not to issue a second request. They've issued warning letters saying, be aware that you close at your own risk because we're not closing our investigation. So as a result, there are now dozens or perhaps hundreds of open investigations at the agencies that, if you listen to staff, are really not being pursued, but they're still on the books and open. They've made a declaration against accepting structural remedies, accepting non-structural remedies, which has led to, I think in some cases, them having to walk away from deals where they otherwise would have taken behavioral remedies. But the dicta is clear. They've expanded the scope of second requests to include issues that never before have been on the table, like labor issues and environmental issues. And they've talked about their commitment to litigate to the outer limits of the antitrust laws. And I think they're now finding out what some of those limits are in these recent cases, for better or for worse. And then finally, they've announced that they intend to amend the merger guidelines in ways that seem clearly defined to expand their ability to use the merger guidelines as a tool in enforcement. So again, most of these initiatives don't apply just to digital mergers, just to problematic mergers. They apply more generally to mergers. So I do think there is sort of a general hostility toward merger conduct and merger activity as a result of the philosophy of the administration.
Thanks. We can just go down the line. Doug?
Let me just add one thought to what John said about what's driving this drumbeat about stricter antitrust enforcement with respect to mergers. I think it's not just the studies and the data that purport to show that there's been increased concentration and evidence of increased market power. I think there's also, importantly, some evidence, again, it's contested, but it's not insubstantial, suggesting that merger efficiencies, particularly in the area of revenue and cost synergies, which are the ones that are testable, have generally speaking not been realized in mergers. And that's really important because so much of antitrust law, including merger law, is built upon the premise that we really have to, above all, avoid false positives. Well, that makes sense only if, among other things, you're really losing something of value with a false positive. And if those merger efficiencies turn out to be largely unrealized, then that case for avoiding false positives becomes a lot weaker. Additional factors that I think are driving the concern are, of course, the general populist foment that we're all experiencing, the concerns about a new Gilded Age, inequality, and the like. And, of course, all of the concerns about the big tech platforms that have been at least regarded as visible champions of aggressive acquisition programs. So what's to be done? In the absence of new legislation, there are really only two things you can do. You can win the cases on the facts, and you can persuade the courts in the common law-like tradition to change the law. Both of those, certainly in the last week, demonstrates this, are very difficult in the current climate, where you have a judiciary that overall is rather conservative and hostile to antitrust enforcement, and where I think antitrust law has become much too arcane. And I think judges don't understand it. And I think that's true in a lot of antitrust cases these days. So I think it's incumbent on the agencies and all litigants to try to speak a language to the courts that they can understand. A huge thing, for example, I think would change a lot, move the needle on enforcement, would be to get courts to understand a proposition that I think is indisputable. That as a matter of law, the plaintiff doesn't have to show that there has been or what kind of harm to consumers or suppliers as a result of the allegedly anti-competitive conduct. The antitrust offense requires showing increase in market power from which conduct adverse to the interest of trading partners is presumed. And if you can persuade the courts to understand that, then you won't have all these opinions and say, well, the plaintiff didn't prove how the prices went up or how quantity went down or something, which is often an impossible burden. Anyhow, those are very difficult challenges. I think that's what's going to happen. I agree with John that the FTC has taken a different approach in part at least, which is a whole host of actions. I have 8 in my list. I'm not sure whether you covered all 8, but you covered most of them, John, that have the effect and maybe the purpose of making merger reviews so onerous and uncertain and prolonged so as to deter mergers without, of course, subjecting the agency's hostility to them to any kind of judicial review. And if you're a populist or a progressive, you might applaud that if you believe in the rule of law, as I do, even though I'm a little to the left of where the law is today. That's not a very happy development.
Thanks.
So tough act to follow. First of all, thank you very much to the Institute for inviting me. And I just say, first of all, for sure the studies, I think for sure anxiety over the realization or lack thereof of efficiencies as a grand justifier for allowing through the consolidation that we've experienced over the last number of decades. But I come at this, and my disclosure is I am a foreigner, I am a visitor, a green card holder, so I'm here all legal, but I am Canadian. I'm only a Canadian lawyer, so I'm here very much as a visitor, and so my observations are just that. As a stranger in a increasingly strange land, I will say. But, I think in my sort of simple reaction to watching what is unfolding, I see both a sort of a capital P and a small p political answer to the question of what is driving this. And obviously those do intersect, but on the capital P, we definitely have a more left-leaning administration anxious to demonstrate, and I think that's a big part of it, and we see that a lot in the, trying to use a value-laden word, sort of the dramatic pronouncements that we see coming from in our little sandbox, the agencies, but more generally in the whole of government approach, the statements that are being made in terms of what are our priorities and what are we trying to cure, which is where antitrust, oddly enough, has come in as the apparently the fixer of all things. But so on the capital P political side, I think that on the small political P side, which is where we're seeing, and it was interesting to watch the panel before us, watching the surprising coalescence actually of left and right, if you can give them those titles, but seeing more conservative traditional folks acknowledging a desire, a deep desire within the population for change, and on a lot of topics that don't necessarily immediately come to mind, or at least didn't traditionally, as things that antitrust was much of a balm for. But in any event, on the small P side, obviously we're seeing enormous anxiety. We are seeing a reaction to the spectacular rise, good and bad, but spectacular for sure, of these marketplaces, of these online marketplaces and platforms, as well as more generally a consolidation among industry. So, what, to me, I see those as sort of the drivers. We've got to do something about it. There's a lot of anxiety. There's, standard of living is dropping and all those sorts of things. And so antitrust has somehow become the great savior. In terms of what that means, I think on a practical level, we're seeing it certainly in my little world, where I do merger clearance. We're seeing fewer deals. We're seeing a lot of anxiety, an acknowledgement that pretty much anything that moves is going to be challenged, or at least it's going to get a hard run, and that scares people off. So maybe it scares off some deals that shouldn't happen. I recall statements in the last administration of these deals should never even be in our office. I think those are being dissuaded, but maybe some deals that should be going through are also not being tested, and we're not seeing the kinds of combinations that may actually be efficiency enhancing. A lot of trepidation. We're seeing this internationally too. I mean, the last fireside was interesting, obviously, to listen to. I think the understatement of the day might go to that panel where there was an acknowledgement of a little greater tolerance for regulation in Europe. So that for sure that's the case, and there's nothing right or wrong about it. It's just a philosophical difference that has tended to be a bigger divide than one feels today on this side of the ocean. So I think that's all I have to say. I think give it to Diana to round us up on this question.
Yeah, Diana, what is driving this sort of renewed push for more aggressive enforcement, particularly on the merger side?
So I think there's a really strong evidence-based case to be made for why we're looking for stronger merger enforcement. AAI, which kind of stakes out the progressive part of the spectrum, center left of center, has a very different orientation than, say, the neo-Brandeisian perspective on the left end, right? I think it's indisputable that there is a growing body of evidence that we are seeing higher concentration. Some of that might, in fact, be due to technological change, to the achievement of scale, scope, and coordination economies. But come on, we've seen massive consolidations in major sectors, right? We've seen the wireless sector consolidate, hospital consolidation has been off the charts, consolidation in pharma. AAI produced a very large report on this last year. This shrinking group of generic drug manufacturers, many of which are now under indictment and involved in other antitrust matters. So there is a strong evidence case to be made for stronger enforcement. I think the big question is, how is the Biden administration going to implement a commitment to protecting competition? And it's very much a work in progress. We all saw the Senate Oversight hearing, committee hearing last week. We have observed the rollout of the various components of the Biden executive order. By the way, the most recent release really focuses a lot on consumer protection as opposed to competition. I think that's a really important thing to watch. So the question is, how are we going to strengthen enforcement? Are we going to work within the existing system, addressing weaknesses like error cost analysis, under enforcement of the structural presumption, burden shift issues in litigated merger proceedings, and then tap into other policy tools to complement antitrust? Or are we going to load up antitrust with lots and lots of responsibilities for which it was not necessarily designed? So I think the administration has accurately identified that merger control is really the first line of defense in rising concentration. If you have strong, effective merger control, then you find yourself doing less battle on the back end by bringing Section 2 cases against dominant firms that got to be dominant because of acquisitions, and of title oligopolies of firms that got to be title oligopolies because of consolidation. So without strong merger control, you're really debilitating a major tool of antitrust law, and putting more pressure on other tools of antitrust law that, frankly, are even more difficult areas. Section 2 law, wow, how many Section 2 cases have we had in the last 20 years? We see rising standards for showing collusion in the courts and private enforcement cases. So Section 7 is really critically important, and I think workers see this in a loss of bargaining power. Consumers see this in a loss of choice and higher prices and less innovation. But I think I have to agree with Doug and others who have said that some real flashpoints here, aside from sort of general concerns about rising concentration, are a growing list of failed remedies in past mergers, cite Safeway, Albertsons, Hertz, Dollar, Thrifty, and other cases, and increasingly failed efficiencies. Efficiencies that are just not panning out. Maybe some cost savings, more static cost saving issues, but certainly not these expansive dynamic benefits that have been claimed to result, especially from vertical mergers. Cite AT&T, Time Warner. Wow, that unwound in less than 3 years. There were no long-term efficiencies realized in that case. Absolutely. So I think failed efficiencies, failed remedies are really playing a big role here. And of course, we're doing battle with some very conservative courts. And so, yeah, the Biden agencies are taking some shots. They're bringing new cases. They're bringing some more of the old types of cases. We're watching settlements very carefully until we turn around the whole let's settle all the merger cases as opposed to moving to enjoin them. That's going to be a major factor of progress or not. So we're really very much in flux right now, and we're seeing those first cases come through the courts. And of course, it's not all a good story, but I think to change the state of the law, you have to be willing to suffer some losses.
Thanks. So sort of driving sort of more deeply into tech deals specifically, and this concept of sort of nascent acquisitions. I mean, it's been talked about for a long time, and there's been cases here and there. We're seeing there's the Facebook VR merger case that sort of is sort of getting right, I think, at the heart of what the FTC, with the rhetoric that's been coming out of the FTC over the last year. And so we'll see how that plays out in court. But how does is antitrust law, like as it stands, like equipped to deal with those types of cases? I mean, the FTC has been criticized for both coming in way too late and coming in way too early. And so how do you find that? How do they navigate that? When is too early? When is too late? I mean, it seems like kind of an intractable problem, but they do have, and they have to bring cases. And so how does that sort of play out with like the current legal framework? And whoever wants to just open it up to whoever. Go for it, John. You invited yourself.
First of all, and maybe a little good for discussion, but just coming back to comments Doug and Dan made, I don't understand why failed efficiencies should be a justification for more aggressive merger enforcement. I've been doing this for at least 3 decades, and I can't think of a handful of cases where efficiencies have been the basis on which the agencies decided not to challenge a merger that was otherwise anti-competitive. So if you're talking about failed efficiencies being a justification for the government to decide what mergers should and shouldn't happen, you're basically saying, let's not let the business people render their judgment, even though they've been doing this for entire careers. Let's let the government decide which mergers are good and which mergers are bad. I don't think that's right. I don't think they're well equipped to do that. So if it's an excuse they want to use, that's fine, but I don't think it's a legitimate justification.
Can I just interject on that before we go into nation? Okay. My point, at least, I won't presume to speak for Diana, was not that agencies should assess efficiencies and use it as an affirmative defense. It was that the law presumes that there are efficiencies, and as a result, puts a high barrier on the plaintiffs in what, legal doctrine today to prove, for example, that harm is more likely than not, without regard to comparing the magnitude of the harm and the magnitude of a magnitude of a false positive versus the magnitude of a false negative, and that the law ought to be recalibrated to take into account the increasing evidence that the presumption of valuable merger efficiencies is, at the very least, very overstated.
I think, not to belabor that point, but I think they've, both Jonathan Cantor and one of his deputies, Andrew Foreman, have, in the context of like the forthcoming merger guidelines, they've hinted pretty strongly that I think they're going to take out any sort of efficiency, not that that has the force of law, but I think that's going to get, and they've struck entirely from the guidelines, if I had to guess. And they've also made the point that efficiencies have never won the day for otherwise illegal deals.
I'll just speak up as coming from a crazy country that actually has efficiencies as an affirmative defense to a merger. Like, you literally quantify the anti-competitive effects and you quantify the efficiencies. And if the efficiencies are bigger, the merger cannot be successfully challenged. So that's a whole other, off the reservation position. But just as an outside observer, I mean, I think the two things that you're saying are actually compatible. I think on the one hand, John, you're pointing out that I don't think we see a lot of, certainly not agency decisions being driven, letting a merger go on the basis of efficiencies. I think they've been skeptical through my entire career. But at the same time, the bias in terms of the design of the burdens within the legal test, again, not an American lawyer, do seem to take into account that there is some presumption of efficiency. So I don't know that those two positions are necessarily reconcilable. But I do think there is ultimately not, in my experience anyway, just watching a lot of mergers that in the judicial side have gone through because of an acceptance of efficiencies, and that was what was driving it. Maybe in vertical deals in the past, but not in horizontal deals.
I would just actually, Doug, take the risk of disagreeing with you. I don't think the law presumes that there are affirmative efficiencies. I think the law puts the burden on the government to show that there's a substantial lessening of competition, irrespective of whether there are efficiencies or not, and absent a reduction in competition, the merger gets to go through. Now, if you're going to say we're going to presume there's going to be a loss of efficiencies with every merger, then maybe the law would be different. I think it's neutral on that point. I don't think it presumes that there are affirmative efficiencies.
Can I?
Well, I think the burden of proof is pretty high, and the question is why is it so high? And I think it's fear of false positive, which must implicitly mean fear that we're losing something if we have a false positive.
I wanted to get to this question of I guess the this Goldilocks set of circumstances for like when is like the perfect time to challenge a deal, because I don't think there is. But I mean, and not to pick on Facebook or Meta, but their Instagram and WhatsApp, they're criticizing the agency for coming in way too late. And with the Supernatural VR deal, the agency is under fire for coming in way too early in a market that is just completely far from established. It doesn't even really, it barely exists. So, how do they make that decision? And like, is there a perfect moment to challenge a deal? And if not, like how do they figure that out?
Well, I think this is a perfect example of the risk of generalizations, because every deal has to be examined on the facts of that deal. And I think to make generalizations about there's been too much consolidation in markets doesn't really tell you a lot. Of course, they should challenge deals when they believe there are anti-competitive effects, and that should happen even if products are in a nascent stage. But that doesn't mean that just because products are in a nascent stage that they should jump to the conclusion that there are anti-competitive effects. There's a lot more to it that needs to be analyzed. And some of the things I think should be looked at are some of the things that have always been looked at. Is it a vertical deal or is it a horizontal deal? I think that's pretty relevant, whether it's a nascent product or not. What's the stage of product development? What's the prospect for that to be commercialized? What kind of financing does a nascent company have? What kind of regulatory approvals does it need to get in order to actually be viable as a standalone product? What's the state of market development? I think that's your point about the VRAR. And look, the fact is that the fact is that digital deals are still happening all the time. And I just finished up 2 deals where I was representing the target and acquisitions by a big platform. One of them was in the VR space, where Meta is the leader. This wasn't Meta, this was one of the other platforms. One of them was in the cloud computing space, where Amazon Web Services. And these were big deals. But the question is, do you want platforms not to be able to position themselves to compete with one another? And if you prohibit all digital mergers, you're going to face that prospect. When sometimes maybe that's your best avenue toward competition is between the platforms. Not that it should be exclusively between the platforms. But making generalizations across the board, I think, is risky.
Well, let me, look, any merger it inevitably involves a lot of uncertainty, and generally mergers involve more uncertainty than conduct cases involving conduct that's taken place in the past, because the merger is entirely about anticipating the future, and you have to compare an unknown but-for world and an unknown merger world and see which one is more problematic, I guess. And that is exacerbated in a so-called nascent acquisition case, because I guess nascent acquisitions is connotes a deal when you have an established firm buying a firm that is not really that's kind of in the very early stages, and so a lot less about the acquired firm and its business and the shape of the market than you do in even an ordinary merger with its considerable uncertainty. So the question is, how do you deal with that problem of uncertainty? I think my own view is that the law ought to be adjusted a bit to get away from the more likely than not standard into something approaching a kind of expected value, so you can take into account, Meta just bought firm X. There's a 1 chance in 10 firm X is going to displace Facebook and be the next big thing. But when you take into account the value of that unlikely outcome, it's a lot greater than the incremental value of X with a 90% likelihood being owned by Meta. I think the law conceptually probably ought to start thinking in those terms. To go to the question of timing, though, look, if you challenge the merger, let's say like Facebook, Instagram, many years later, you've ameliorated the uncertainty a little bit, because you know a fair amount about what happened to the merged parties with the merger, but you still haven't learned anything about the but-for world. So you really haven't solved the merger problem, the uncertainty problem hugely, and there are real costs in waiting. Certainly injunctive relief is much harder to achieve efficiently for any number of reasons. There are changes in the marketplace, changes in the acquired firm, scrambling the eggs and the like. In addition, there are some perverse incentive problems if you have the specter of post-closing enforcement. Firms will be reluctant to invest in the acquired firm and to realize the efficiencies they might otherwise realize. And they might engage in a strategic behavior, inefficiently to scramble the eggs in order to make divestiture less likely. Facebook might have done that with its announcements about WhatsApp and Instagram on the eve of the litigation. Or they might have perverse incentives simply to hold the acquired firm on a short leash rather than allowing it to grow into what it could otherwise grow into. So I think absent a situation where there have been post-merger developments that enable the enforcer to say, oh, wow, we've learned something we really couldn't have figured out beforehand. An occasional case like that, absent that, I'm not in favor of deferring challenges to nascent acquisitions in the hope of reducing uncertainty. I think the better solution is to rethink the legal standards we should apply to nascent acquisitions ex ante.
Diana, what's your thoughts on when is too early, when is too late? How do we make these decisions, and do we need new standards?
Sure. So let me go back a little bit and what we know about digital business ecosystems and how they grow. So we absolutely now have three categories of mergers. We have horizontal mergers, we have vertical mergers, and we have what I call ecosystem mergers, which are typical of a digital business ecosystem model where you have some sort of platform, you've got cloud infrastructure and technology, and then you have this constellation of applications throughout an ecosystem. And those ecosystem mergers they're here, and we're going to see more and more and more of them. Even the United Healthcare Change Healthcare merger is an ecosystem merger because they're sitting on an incredibly valuable digital platform for healthcare information and technology. So when you deal with ecosystem mergers, you have to kind of adjust the lenses in terms of what theories of harm you're looking at in terms of adding in assets that will bolster a horizontal position, adding in assets that will build out a vertical position, and adding in assets that allow for the leveraging of market power across an entire ecosystem. So AAI has done recent research that really shows that the digital business ecosystems grow through acquisition. It's stunning. It is absolutely stunning. The difference in the growth pattern and the model for digital business ecosystems, they do not grow organically. They grow through acquisition. So that's a reality, an economic reality. And absolutely, a lot of those acquisitions are designed to eliminate potential rivals. And, we all know the standard theory of potential competition. There's perceived, there's actual. We've got some very old cases on this. It's generally an underemployed theory of harm. But nascent acquisitions are a little bit different. Nascent rivals really pose a competitive threat and stand to challenge the market position of a dominant firm. So there are very strong incentives for these large digital platforms to acquire nascent rivals to neutralize them. They're a competitive threat, so let's acquire them and we'll neutralize them. And there is strong evidence that this has happened. So I think for antitrust enforcement, it means a bunch of stuff. It means we have to start thinking about different types of evidence, like intent evidence, which was certainly the case in Facebook's acquisitions of WhatsApp and Instagram. So actual evidence, documentary evidence that, hey, we're acquiring this rival so we can neutralize the competitive threat. And that means that we're going to have to advance the lexicon of evidence that enforcers and ultimately courts are willing to consider. And of course, there's going to have to be test cases. And we have an interesting test case at the FTC and the Meta within transaction, the VR virtual reality transaction, where the potential competitor is not the small rival. It's actually the large dominant incumbent firm. So that'll be a really interesting thing to play out. But absolutely, we need new standards. We have a structural presumption in mergers. We need vertical presumptions in mergers. And we actually really do need a presumption around acquisitions of nascent rivals.
So there was a lot of talk in the first panel about legislation, and the bills that are being mostly talked about, 2992 or the self-preferencing bill and the App Store bill, those don't really touch on mergers. There are bills pending in Congress that deal with mergers. Some of them are quite onerous, that some deals would just be wouldn't be allowed at all. Do you, particularly around these sort of ecosystem kind of nascent acquisitions, do we need more clear, is legislation helpful to like provide a more clear roadmap? Is that something that would be useful in this context rather than just piecemeal enforcement where you're sort of at the whim of the court on any given deal, and one judge would rule one way and another judge could rule entirely a different way? Melanie?
Just have a comment on the last question and then try to dovetail probably inelegantly into answering that question. But I wanted to say many of the things I'm not sure I do fully agree with Dan on, but what I really strongly agree with her on is that as a former head of an agency, you have to be prepared to lose cases. That is not a reason to try. You have to. That's the only way business is going to get any certainty. That's what they really want more than anything. I said someone said that on an earlier panel, and I think that's absolutely true. And it gives them the courage to do the things we want them to do, which is to take chances. Gives them framework, gives them some certainty. In terms of whether nascent competitor acquisitions are some sort of special flavor, I guess in my respectful view, and I know I sound like a dinosaur when I say this, but I haven't seen a substitute offered yet that would serve every constituency better than what we have. That doesn't mean we don't have to, it's an overused word, but pivot a little bit in terms of answering to the constituencies that are demanding action, and in many cases legitimately so as to ensure that we ask the right questions and we ask them hard enough and we ask them in a timely way. There are absolutely circumstances where the current questions, if asked in a thoughtful way, will demonstrate ex ante that some mergers of nascent competitors do tilt more towards anti-competitive prospects than pro-competitive. I don't think that's the majority, probably. I think the sort of notion that there's this universality of negative things about the acquisition of nascent competitors, I think that is supported by a number of assumptions, some of which are demonstrably false. So, for example, we talk about this but-for world. There's this notion that if the acquisition of the nascent competitor is ultimately successful, that technology or that whatever it is on the dominant platform is successful, that necessarily, had it been left alone, it would have thrived. I think that's an assumption that does not stand up to scrutiny, and so it cannot possibly be the justification. That doesn't mean that run through the right filters, you wouldn't find prospective acquisitions to be problematic. On the, I think there's nothing, every generation thinks that they've come across the ultimate change. We're hardly the first ones to think so. Think back, it sounds kind of quaint, but remember when like the eating up of the high street stores by the big box was just an absolutely mind-shattering idea that was a kind of a visceral reaction to, and it felt something had to be done. Well, we've all moved on. And today, very legitimately, and I don't mean it in any kind of pejorative way, today we're very concerned about our privacy and the fact that we can't really function in today's world without sacrificing an enormous amount of our privacy to be then traded and others to profit from. So I'm not saying it's not legitimate. I just think we need to sort of keep some perspective, try not to be Chicken Little, try to put some measure into the measures that are taken and are being debated. In terms of timing, I think it's true that there are risks to not moving on a problematic acquisition or conduct, whatever it be, in a timely way. For sure, in the case of an acquisition, you've got scrambling of eggs, you've got changed incentives, you've got the passage of time, but you're fortunate here in the United States to have no limit on the time after which you can go after a merger and challenge it. You've also got Section 2. Again, I shouldn't be speaking in this room of experts, but you've got other tools that you can use. And I think, sometimes you're going to end up tucked into Papa Bear's bed before you realize there's a problem, but sometimes you'll be able to get it before the Goldilocks, perfect if there is such a thing, medium. So I think in terms of what legislation can do, I think Bill made a comment, and I thought it was interesting, about the trapdoors and the outs and all of that. And I wonder whether, and just raised a question in my mind, whether it's not so much the contours of the actual proposal as the way in which it is being presented. And it is being presented in companion with, and I don't mean hysteria in nearly as pejorative a way as I just mean emotion with which the change, the sea change is being talked about, that it is in that context that people read through. And as Bill said, I'm sure a lot of people who criticize it haven't actually read it. It's not so much necessarily the particulars, but rather the environment in which it is being put forward that is causing an enormous amount of anxiety.
I can't follow that. I agree with almost everything you said. I'm not sure about the getting in bed with Papa Bear. I'm not sure what that meant, but leaving that one aside. I agree with it, but just a couple of additional thoughts. I was with a group of, you might call center-left folks, not too big a spectrum, too big a segment of the huge spectrum of people abusing antitrust, trying to come up with some recommended language for legislation. And it was kind of the dialogue with some of the people on the Hill and so forth. And even this center-left group couldn't come up with language that we all agreed on. It's really hard to try to write legislation. So I kind of agree with Melanie's skepticism about legislation. In the nascent acquisition area, the problem is it's not a clear distinction between a nascent acquisition and a more mature acquisition. Instagram wasn't really just a startup when it was bought. It was pretty early stage, but it wasn't a startup. And so where do you draw the line? I think what you need is a coherent vision of how you ought to think about mergers. And I suggested this expected value rather than more likely than not standard is maybe a way to think about them. And I do think, as you referred to very briefly, Melanie, that in a particular subset of nascent acquisition cases where the theory is, and this is not, for example, Meta and the new VR thing, but it's probably Instagram, where the theory is the incumbent monopoly is trying to nip in the bud a threat to its monopoly. I think those cases can be brought under Section 2. We don't need Section 7 jurisprudence for that. I think Microsoft and Section 2 are good enough for that. So I really don't. I don't think we need new legislation. I happen to think, by the way, that the problem with the AI OCA or whatever it is, maybe in part the emotion and the political context in which it's presented. But I think it's also that the coalition that was required to get it out of committee created a camel that, in my view, isn't a very good law.
With nascent acquisitions or just, I guess, not just nascent deals, but startup deals in general, the sort of the concerns of from some of the skeptics of this sort of new way of thinking, this tougher way of thinking, is that it will lead to reduced investments in startups. There'll be less innovation. I mean, that's an argument that's been made for years, for decades. How valid is that argument? Is it a real concern? Is it overblown? And if it is a real concern, is there a way to have a more aggressive stance with sort of minimizing some of these impacts on innovation, if that is an outcome?
So I do think preserving innovation should be a centerpiece of anything that's done. It's been the engine that's driven American growth, period, for the last decade or more. But I don't think enough is known about how innovation happens and how investment in innovation happens. I mean, think about this. If someone came along and said, I've got a product, it'll be Google but better, would you invest in it? I'm not sure that would get funded, right? Because Google's already Google. And the next thing that upends Google, if there is one, and when there is one, is going to be something that end runs Google the same way, Microsoft isn't quite what it used to be because now you don't live and die by just, fixed computing. So I think the way innovation happens is important. And if anyone has sort of been through, a Series B investment and what's thought about, VCs spread their portfolio broadly. They want a return on investment. They want to know what the timing of that return on investment is. And you're not going to see many VCs who are going to invest in a company that's going to sort of build from scratch a metaverse product to maturity. Because you're talking about billions and billions and billions in investment and a huge amount of time. And VCs essentially aren't in that game. They're not in that market. So I do think innovations are going to happen incrementally. I think that's how they are happening. I think the way that they get accumulated to make products, to make competitors, is not happening. Again, it's not two guys in a garage. That's never going to happen. You're not going to find two guys in a garage who are going to upend a Google or a Meta or a Amazon. So I think we need to know a lot more about how that happens so that what we do, whether it's legislation, whether it's increased enforcement, preserves the engine that has really helped America grow.
Doug, thoughts on how innovation policy and merger enforcement policy can...
Well, I kind of agree with, I think, what John was saying. We do know some things about innovation, but not a whole lot. Certainly not in a case-by-case way. I mean, antitrust lawyers are the last people in the world to predict what company is going to, be a good investment for a venture capitalist. And I do think it's really important that we not materially deter VC investment in the tech space because of a concern that the exit path of selling to an incumbent platform is too fraught with peril. Let me try to speak in more intelligible language. If we had a rule that said big companies can't buy little companies, I think not only would we lose a lot of benefits of the merger, sort of the ex post efficiencies, but I really think, from what I know, and I don't think anybody has deep knowledge, but from what I do know, I think we'd really chill desirable risk-taking investments, early stage investments in the capital markets in potentially important, innovative new products and new companies. So I do think that if we're going to crack down, as it were, on nascent acquisitions, we have to do it very selectively in a way that makes clear to the investing community, A, we're not closing off the exit by acquisition path for your investment. And B, we're going to be careful to move only in those cases where we're reasonably confident, I'm not sure what that means yet, but reasonably confident that the acquired firm has another path to prosperity, without which, by the way, how could the acquisition show competition? And with which the investor can say, well, I'm going to get a good return on my investment. And if we can provide those two assurances to the capital markets, then I think we can both have maybe a somewhat more aggressive merger policy without unduly risking innovation.
Diana, I know you have to jump off a little bit early, but I wanted to get your thoughts on how carefully we need to tread to protect innovation. I mean, after all, there are other exit opportunities available to investors and startups as well.
Right, and I just want to make sure you can hear me because I've got a frozen screen. So am I audible?
Right now, you're great.
Okay, great. So yeah, this will be my last comment, and I apologize for having to hop off. But I think the answer is absolutely, we want to protect innovation. Innovation is what fuels a market-based economy and all of the democratic principles that underlie a market-based economy. And we have advocated at AAI for the agencies to bring more standalone innovation cases. Usually you see innovation claims tacked on to price effects or even quality effects. And we've had some cases, Tokyo Electron, for example, John Deere, Visa Plaid, but we need to see more of those types of standalone cases to really advance the state of the law on that and get the courts comfortable with dealing with standalone cases. I'm very skeptical about arguments that, wow, really strong, vigorous merger enforcement is going to stifle innovation, right? Well, I think it's quite the opposite. As an economist, we're always looking at barriers to entry. And what we see are higher barriers to entry. We see less rates of entry into markets, largely because of very high levels of concentration. So if we want to see entry by innovative entrepreneurial firms. We want to keep entry barriers low, and merger enforcement is really a major vehicle for doing that. And frankly, antitrust should not defer to any particular model of innovation like the VC-backed startup. Antitrust has always been generalist. It has always applied across all industries, sectors. I don't think carving out a particular model of innovation, which is the VC-backed startup, is really in the interest of promoting the goals of antitrust, certainly as law enforcement. It gets us really deep into the weeds on opining through the law about what kind of innovation do we want? We know that startups who know that they are or are attempting to be acquired will innovate in very, very different ways than startups that remain standalone and grow to be viable competitors who could potentially challenge an incumbent market position. So I think this is really a very sticky area, and we're sort of on the precipice here of buying into some arguments about why antitrust should favor certain models of innovation, why merger enforcement discourages innovation when in fact it should encourage innovation by keeping entry barriers low. And I think this deserves a lot of thought, and we could use some more guidance from the agencies on these types of issues. Not sure whether that's coming out in the revised merger guidelines or not. But certainly the digital business ecosystems have teed up these innovation questions, especially about nascent rivalry. And I don't think it's going away. You know, the world is moving in a digital direction, and we're going to see digital issues and ecosystem mergers and issues pop up across a lot more sectors.
There's going to be plenty of cases for the agencies to deal with. I mean, companies are not stopping their deal making. And you mentioned this at the beginning, Melanie, but I'm curious for you too, John, the idea, like, are you seeing clients being more hesitant, more risk adverse? Are there deals that companies may have done a couple of years ago, but are not going to do anymore, or more hesitant to do now? Like, how is that? What are you seeing out in the world, out in the real world? Like, what is the...
I think he's asking you.
Oh,
Both of you, but you already mentioned this, so I'll go to John first.
well, look, companies, especially the larger platforms, know that they're under the microscope, right? And they are going to be very thoughtful about whatever they do, whatever transaction they do, and they're going to analyze it, very thoroughly, and they do. But at the end of the day, there's a law, and the law says that it has to, substantially lessen competition. And if there are transactions that they can do that they think will not do that, don't even risk that proposition, and they think they'll be beneficial, then they're doing those deals. And at the end of the day, the question isn't, is it nascent, is it not nascent? The question is there a theory of anti-competitive harm that the agencies can prove? And in most of these cases, there's not. I think the whole idea of nascent competition benefited from really good marketing with the term killer acquisition. That was a cool term, right? Everyone wanted to know, what is that? But we really haven't seen a lot of those killer acquisitions, again, because I don't think the platforms are really worried about somebody coming directly into their market and saying, gee, we got to take these guys out before they do that. In part because they're pretty secure in the markets they're in. I think what they're thinking about is, how can we build our ecosystem to get more value out of what we already have? And that's an area where I do think there should be a lot more research done as well, because I think no one has really even approached the ecosystem question, the ecosystem problem, and whether that kind of expansion is creating more competitive problems than the traditional theories would lead us to conclude.
I mean, I think what I'm seeing is assessments being made at the board level about whether to pursue something with, to my mind, and perhaps not properly read, but from the public square conversation, the factor of the cost just of going through the process as having been quadrupled. And that is taking a lot of weight as do we go, do we not go? And to me, that is inefficient. That's not positive. We're risking losses of positive consolidation. And oddly enough, often in times I'm seeing it where it's like, wow, you shouldn't be worried in an ordinary environment, and even in this environment, you shouldn't be worried. But there's a risk aversion through the uncertainty that's being fomented through the commentary. If I understood Diana properly, I don't want to say she said something she didn't, but I totally agree. We shouldn't get transfixed by this one kind of merger, this acquisition of nascent competitors. There is absolutely, legitimate pro-competitive merger enforcement that can happen in a principled environment for nascent and other competitors that can be pro-innovation. We just need to keep our mind on it. As a Canadian, I have grown up my entire life envious of the productivity and innovation that the U.S. has every reason to have been incredibly proud of. I hate to see that under assault in any way, if indeed it is. My last word would be to say that I agreed with really everything that John and Doug said on this point. I would disagree only that I think antitrust lawyers are only the second worst people at picking winners and losers. The government's even worse.
Are there collateral effects for like companies like sort of the next couple rungs down in size where they, all the talk is centered on sort of the big 5 tech companies, but there's a host of sort of slightly smaller, medium tech or whatever you want to call it. Is this reaching them too, do you think, this sort of new stance, or is it, do you see it as just focused on the big 5, on the largest, and what kind of risk does that create for sort of slightly smaller companies in the tech sector? Doug?
Well, I think your prior question was prefaced with some comment about what are you seeing in the real world. The last 8 years I've been at Stanford, so I have no idea. I would expect that what Melanie's observed is not limited to the GAFM platforms, because what I think, as I understand what she's saying, she's describing what I think is a predictable reaction to the way the agencies, and in particular the FTC, have talked about and implemented policy changes respecting mergers in general.
Yeah, I guess I've observed this, 2 things. One is that the kind of mid-sized tech companies are trying to keep their heads down and say, hey, look at those guys, right? And point at the platforms. But in terms of their acquisition strategies, I think, they expect to have more challenges in getting through the process than they used to. The way we now find ourselves having to talk about deals is to say, here is the rational analysis under the law, under the current guidelines. Here's the X factor, right? Here's the X factor. And those chilling issues I talked about earlier, the things that the agencies are doing, I think is intended to create a bigger X factor, right? Or at least a bigger range of risk. In practice, we're not really seeing that come to bear in terms of stopping more deals than it used to, or even complicating deals the way one would fear. Most of the deals that should get through the process relatively quickly are getting through the process relatively quickly. The ones that are not, and that are going to second request, maybe when they wouldn't have before, or they're being dragged through the second request process further than they would have before, ultimately are getting through, in the same kind of way they would before. And, we'll see whether that changes. I think the agencies are struggling right now with staffing. I know the staffs have a huge number of investigations, so there's an objective to try and expand what they're doing and to try and increase the enforcement, but they've got to find cases they can actually win. Mm-hmm. And I think they're struggling to find those cases. And maybe because companies are being more cautious and aren't taking quite as many risks as they would have in terms of those gray area deals that they used to do.
So just to take a step back, and I want to leave it a few minutes open for questions too, but to take a step back and go back to the first part of the conversation, there's this idea now that sort of, I think almost mergers are sort of a net, in general, are a net loss for society. And I'm wondering, like, if this continued chill on M&A, like, what is the sort of longer term? Is it going to be, is everything going to be fine? Are there like terrible consequences down the road if this continues, if this sort of stance continues, like across administrations? I think there's a movement amongst sort of the progressive antitrust folks to sort of keep this going past the Biden administration. They've found a really receptive voice in President Biden, and I think they're trying to sort of lay the groundwork to continue this across administrations. But what is, if it continues, like what are there long-term like economic consequences? Like how does that, I know it's just like, it's an impossible question to answer, but like what are your,
Well,
how do you guys think
I
about
want
that?
to comment on if it continues. I think without new legislation, my guess would be that the new Brandeisian push, it has about 2.25 more years to go. And I say that because I don't think they've had, so they certainly have not had, and there's no evidence they will have much success persuading the courts in the common law-like tradition for lots of reasons having to do with the composition of the courts and the failure of the left or the center left to come up with a kind of coherent field theory, the way Bork did in the 70s, you know, as an alternative. So the law is not going to move. And certainly a Republican administration, however hostile they may be to the tech platforms for reasons having little to do with traditional antitrust concepts, they're not going to support and are not supporting broad antitrust reform now. And I don't even think a next Democratic administration, at least a post-Biden Democratic administration, is likely to go too far in the Warren-Sanders direction. So I think it's legislation or bust for the new Brandeisians.
John?
I would like to think that Doug is absolutely right, largely because I've been doing this for a long time and trying to understand antitrust. And unless things change, I don't think any of us understand antitrust anymore. Because now it's sort of pointing to the wild blue yonder. And, you know, just take, for example, the consumer welfare standard, where, you know, you get in the US, and by the way, not really elsewhere, you get a lot of people saying, gee, is this the right standard? And suggesting it's not. But I don't know what the other standard is, or, you know, what the other standards are. And it seems to be, you know, whatever you want it to be at the moment. So is it a blip? I don't think so. I don't think it's entirely a blip. I agree with you that the law will constrain what can be done in the absence of new legislation. But when I talk to people of the next generation and the generation after that, right, the sort of up-and-comers, they have a different mindset about what this should be. You know, I was brought up kind of learning that, gee, the antitrust concepts of the 60s have gone by the wayside, and here's the new way of thinking, you know, Chicago School and Harvard School, which is a refinement of that. And now, you know, that seems to be not the way that people of the next generations are thinking. So I really do think there's going to be a continuation of this desire to rethink about, you know, the balance between business, enforcement, regulation, and society in ways that, at least in my generation, you know, haven't existed until now. So we'll see. We'll see. Maybe this is a trend. You know, maybe this won't last any longer than, you know, the latest TikTok video. But I do think there's a change in mindset that's going to persist for some time.
I should hardly have the last word as the non-American on the panel, so we should close it with someone else. But you know, I think you're asking the wrong people. I mean, as much experience. I mean, I feel daunted to sit up here with these folks, but you know, it isn't our game anymore. So I almost question whether, like, when we think about antitrust, we think about it in a certain framework. I can get to kind of privacy and the importance of potentially incorporating that as in the right way as an interest for consumer welfare. And by the way, I don't think consumer welfare needs to be just reflected in price. It can be reflected in all sorts of things that consumers value. So if consumers value privacy, that can make its way into a totally coherent, in my view, approach to an antitrust assessment. You start talking about climate change, I get a little less sure about it. You talk about income inequality, I think indirectly, a pro-competitive economy and a healthy ecosystem promotes it, but I have a lot of difficulty seeing how it works itself in. But I mean, we're all running off into the sunset pretty soon. We're not the ones who are going to be
Speak for yourself.
well. I don't think I'm much younger, a little bit, but I don't think. I just think it's interesting. I don't. It's always the case as the elders are asked, but I'm not sure that we're actually going to be the best judges, because I think the people you refer to as you speak to, John, bring a very different prism to how they look at these questions.
Yeah. I do think that Jonathan Cantor a few times now has made the statement that the consumer welfare standard there isn't really one definition of that, and I do think there's some truth to that. I do think, like, if you ask like 5 people to define it, you might get 6 or 7 answers. I mean, it's not codified in any statute. We're running out of time. I would like to leave it open for a question or two if we have anything. Alan?
We haven't got any predictions yet about what the new merger guidelines are going to look like, and I'd be curious if anybody has any predictions.
I will tell you what I'm hearing behind the scenes for what this is worth, and it's probably not worth much. But I have heard some people say that in terms of how it interprets, that they're going to look very different and read very different. But in terms of the fundamental principles on which they rely, that they're not going to be as different as people fear. I was talking to one person who said, look, maybe I'm drinking the Kool-Aid, maybe I've read them too many times, but I don't think it's all that different than where we've been for the last 15 or 20 years. We'll see. We won't know until they're out. I find it interesting, though, that the idea is they say, well, we actually want to just hew to what the statute says and to what the cases say. And of course, they're selective about which cases they cite. I don't know why you need to change the guidelines to do that. You would think that that's exactly what's happening in these court battles, right? Is that the courts are looking at the statute and the precedents, and the agencies aren't faring so well. So I don't know why you need to revise the guidelines to do that. So there's clearly some purpose-driven, outcome that they have in mind here. And if you look back at the last 2, at least, revisions to the guidelines, those were done to kind of overcome court reliance on the previous set of guidelines that had hurt the agencies in litigation cases. So we might be seeing some of that coming down the road as well.
Well, I'm on the wrong coast. I don't have the kind of information you're getting. But just a couple of thoughts. I do think there's a way that the guidelines, without making any substantive change at all, could have a desirable kind of cosmetic or rhetorical effect. Because I think the guidelines, I think readers of the guidelines think merger law is all about diversion ratios and other kinds of econometric exercises. All about is an overstatement, but that component of merger analysis, I think, weighs very heavily in the sense you get from the current guidelines. And if we're trying to respond to the criticism or give voice to those who have the criticism that antitrust has been co-opted by a bunch of technocrats, or the concern that courts don't understand any of this anyhow, then I think you could change the flavor of the merger guidelines without changing the substance very much, and that could be a big plus. And if they go very far and really sound like Lena Khan or even Cantor in some of their speeches, I think they're going to run a substantial risk of not having any impact on the courts.
All right. Any other questions? Yeah, we'll take one more.
So implicit in a lot of today's discussion is, in a merger context, is that a large digital platform is one of the merging parties likely to be acquired, right? But to use Josh's classification, what if the acquirer is a medium tech firm, and the justification the merging parties are putting forth is that we need to consolidate in order to better compete with a digital platform, either because the digital platform is dominant there, or because they're entering already, or they're on the edge of the market, right? Obviously, this is not a new argument. It's been used many times before, but have you, in your experience, seen a different reception at the agencies to this type of argument because they fear, well, if we don't allow, we don't like consolidation, to be sure, but we also don't want new markets, adjacent markets to tip because of network effects and other issues. Is that, getting a little bit more of a warmer reception these days, or is it so case by case that you're unable to comment on it?
Actually,
So I will tell you, I think we're all struggling to hear the entire question, but I did get, I think the sense of it is our arguments that markets are going to tip more influential, or being considered more deeply by the agencies than they used to be. Is that the crux of it, Frank? Oh,
Smaller set
The
of
next level
Small
down.
mid-tech companies.
Yeah.
I think when you get to smaller mid-tech companies, at least from my experience, the focus on the same kinds of concerns that are pointed at the big tech companies really fall by the wayside. And while they're looking very closely at those deals, maybe more closely than they used to, I don't think you're looking at very different theories of harm than you used to, because you don't have the same kind of dynamic of these really big companies have this huge amount of market power, and therefore we shouldn't let them grow. And I do think there's an overhang of that to anything the tech platforms do. I don't think the same thing is true to the mid-tech companies. And in some ways, at least in one deal I'm thinking of, one of the arguments that we made is this will actually position us better to compete with one of the big platform companies, and that got some good nods. So
Interesting.
Yeah, I think you can't dismiss entirely either the fact that these are agency heads who live in a political environment, and going after we never heard of them, buying we never heard of them, isn't going to get the kind of play that pick one of your big guys buying anything. Doesn't matter if you've never heard of the thing they're buying, would get.
let me just say, if Melanie is right, it's really unfortunate, not only because we may be failing to bring cases that ought to be brought, but because if I were at an agency and I really wanted to push the law to the left, I would be picking cases that have the kinds of facts that would enable me to persuade a court to adopt an incremental change to the law. I wouldn't be worried about today's headline. I'd be worried about tomorrow's precedent. And I'd bring exactly those cases if I thought I found a good one.
But you'd have to find the good one. And I think John's point is there aren't as many candidates that are good in the mid-tech space. But I don't mean to sound too cynical, and I hope I'm wrong, but I fear there's a little bit of truth in what I
I
say.
don't quarrel with your statement.
Well, I think we're going to learn a lot from the challenge to the meta within deal, right? Because there are a lot of people who think that's not a great case for them to bring. And we'll see. I mean, maybe they're wrong. They could get some great case law out of it, or they could get some really painful case law out of it. But I think that's a deal that's going to kind of point us in the future direction of where things are headed.
We'll know soon. December. All right, I think that does it. Thanks everybody for coming. I want to thank LeadershIP and the panelists and you guys here in the room and the viewers online. It's been a great chat.